Hello friends. I need to start this video with something that surprises a lot of people, and I want you to sit with it for a moment before we get into the details. The Social Security benefit you spent your entire working life paying into, the money that was taken out of every paycheck you ever earned, is taxable income. Not for everyone, not in every situation. But for a larger number of retirees than most people realize, a significant portion of that monthly check gets counted as taxable income by the federal government. And the rules that determine whether you are in that group were written in 1984 and have never once been updated for inflation. Which means that every single year, more and more retirees who are never supposed to pay this tax are being pulled into it, simply because the cost of living has gone up and the thresholds have not moved. If you are currently having federal taxes withheld from your Social Security, or if you file a tax return and your benefit is being counted as income, this video is going to explain exactly what is happening, why it is happening, and what legal options exist to reduce or eliminate that tax burden going forward. Stay until the end because the strategies I will cover in the second half of this video are the ones most people never find out about until it is too late to use them for that year. Subscribe to this channel and hit the bell before we go further. This is exactly the kind of information that directly affects your monthly income and that the SSA does not explain to you. Subscribe now and let's get into it. Here is how the tax actually works. The IRS does not simply tax your Social Security benefit the way it taxes a salary. Instead, it uses a number called your combined income to determine how much of your benefit is subject to tax. Combined income is calculated by taking your adjusted gross income, adding any tax-exempt interest you received, and then adding half of your annual Social Security benefit. That total is your combined income number, and where it falls relative to two thresholds determines your tax situation. If you are a single filer and your combined income is between $25,000 and $34,000, up to 50% of your Social Security benefit can be taxed. If your combined income exceeds $34,000, up to 85% of your benefit can be included in your taxable income. For married couples filing jointly, those thresholds are $32,000 to $44,000 for the 50% tier and above $44,000 for the 85% tier. These numbers sound straightforward. The problem is what they look like in practice. A single retiree receiving $1,800 a month in Social Security, which is $21,600 a year, and withdrawing $15,000 from a traditional IRA to cover living expenses already has a combined income of approximately $25,800. That puts them inside the taxable range. They are not wealthy, they are not high earners. They are a typical retiree drawing on retirement savings to supplement their Social Security, and they are paying federal tax on up to half their benefit because of a threshold that was set 40 years ago and has never been adjusted. Here is the part that makes this particularly frustrating. When Congress established these thresholds in 1984 and expanded them in 1993, they were designed to affect only higher income retirees. At the time, $25,000 was a relatively high retirement income, but because the thresholds have never been indexed to inflation, they have remained completely static. While incomes, Social Security benefits, and the cost of living have all risen steadily, $1 in 1984 is worth roughly 30 cents today. The threshold has not moved. The result is something called bracket creep. Every year, more retirees cross these thresholds, not because they are better off financially, not because their standard of living has improved, but simply because everything costs more and their Social Security benefit, which does get adjusted for inflation each year through COLA increases, now pushes their combined income higher. The COLA increases that are supposed to help seniors keep up with inflation are ironically the same increases that push more of their benefit into taxable territory. Estimates suggest that more than half of all Social Security recipients now pay some federal tax on their benefits, compared to roughly 10% when the law was first written. That is not because retirees got wealthier, it is because the law never got updated. I want to tell you about a woman named Barbara from Cincinnati, Ohio. Barbara is 72 years old and retired at 67. She receives $1,650 a month from Social Security and withdraws about $1,200 a month from her traditional IRA, which she spent 30 years building while working as a school administrator. Barbara always assumed her Social Security was not taxable. She remembered someone mentioning years ago that retirement benefits were tax-free, and she never looked into it further. When her tax preparer explained that approximately $9,000 of her annual Social Security benefit was being counted as taxable income, Barbara was genuinely shocked. She had been paying this tax for 5 years without understanding it. She had assumed the withholding on her IRA withdrawals was covering everything, and that her Social Security was sitting outside the tax calculation entirely. It was not. More importantly, she had been making IRA withdrawal decisions that were quietly making her tax situation worse each year. When a relatively simple adjustment to how and when she took those withdrawals could have kept her combined income below the threshold. She was not doing anything wrong. She simply did not have the information she needed. That is what this video is for. So what can actually be done about this? There are several strategies that are legal, widely used, and that a lot of retirees never find out about in time. The first strategy involves managing your IRA withdrawals carefully. If your combined income is close to one of the thresholds, reducing your traditional IRA withdrawal by even a few $1,000s in a given year can keep you in a lower tax tier or below the threshold entirely. This requires knowing your numbers going into the year, not at tax time when it is already too late to change what you withdrew. If you have not already, sit down and calculate your projected combined income for 2026 before the year ends. If you are close to $25,000 as a single filer or $32,000 as a married couple, reducing your IRA distribution could meaningfully change your tax bill. The second strategy is Roth conversion. If you have a traditional IRA, moving a portion of it into a Roth IRA over several years can permanently reduce your future required minimum distributions and therefore reduce your future combined income. Roth IRA withdrawals are not counted in combined income the way traditional IRA withdrawals are. This means that a retiree who has converted a significant portion of their savings to Roth before RMDs kick in can have substantially more flexibility and a meaningfully lower tax exposure on their Social Security for the rest of their retirement. The trade-off is that you pay income tax on the converted amount in the year of conversion. The strategy works best when done gradually over several years during a lower income period, ideally between retirement and age 73 when required minimum distributions begin. The window between the year you retire and the year your RMDs start is often the best opportunity to do this. Many retirees who did not do Roth conversions during that window end up with large RMDs in their 70s that push their combined income well above the 85% threshold for years at a time. Planning ahead changes that outcome entirely. The third strategy is qualified charitable distributions, sometimes called QCDs. If you are 70 and a half or older and you have a traditional IRA, you can direct up to $105,000 per year directly from your IRA to a qualifying charity. This distribution counts toward your required minimum distribution, but it does not appear as income on your tax return, which means it is completely excluded from your combined income calculation. For retirees who give to charity regularly anyway, this is one of the most effective and underused tools available. You satisfy your RMD obligation, you support a cause you care about, and you keep your combined income lower without having to change your lifestyle or spending. The fact that so few people know about this option is one of the more frustrating gaps in how retirement tax planning gets communicated to seniors. The fourth strategy involves timing. Some retirees have flexibility in when they receive certain types of income. A part-time consulting payment, rental income, or a one-time financial event can push combined income over a threshold in a single year and create a tax bill that could have been avoided with different timing. If you have any control over when income arrives in a given tax year, understanding how that income affects your combined income and your Social Security tax exposure is worth thinking through before the income arrives rather than after. The fifth thing worth knowing is that 13 states currently tax Social Security benefits at the state level in addition to the federal tax. Those states are Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, North Dakota, Rhode Island, Utah, Vermont, and West Virginia. If you live in one of these states, your total tax exposure on your benefit may be higher than the federal calculation alone suggests. Several of these states have income-based exemptions that reduce or eliminate the state tax for lower-income retirees, and some have recently updated their rules. Minnesota, for example, has been working to expand its exemption thresholds. Missouri has an exemption that phases out at relatively modest income levels. If you live in one of these 13 states and you have never specifically looked into your state's Social Security tax rules, it is worth doing. The exemption thresholds vary widely, and in some cases, a retiree who qualifies for the state exemption could be saving several $100s a year simply by filing the right way. Here is the simple summary of what I want you to take away from this video. Social Security benefits are taxable for a majority of retirees in 2026. Based on a combined income formula that uses thresholds set in the early 1990s and never updated. The more income you draw from traditional IRAs, pensions, or investments, the more of your benefit gets counted as taxable income. This is not a fringe situation affecting a small number of high earners. It is the default reality for most retired Americans today, and most of them did not see it coming. The strategies that reduce this tax exposure: managing IRA withdrawals carefully, doing Roth conversions during lower income years, using qualified charitable distributions to satisfy RMDs, timing discretionary income thoughtfully, and understanding your state's specific rules, are all legal, widely available, and almost never explained to retirees in plain language before they are already deep into retirement paying a tax they did not know to prepare for. You now know these strategies exist. If your Social Security is currently being taxed and you want to understand whether any of them apply specifically to your situation, speaking with a tax professional who works regularly with retirees is worth every minute of that conversation. One planning session, one afternoon of your time, can change your tax picture not just for this year but for every year that follows. Subscribe. Share this with someone you know who is collecting Social Security and may not realize how much of it is going back to the government in taxes every year. Most people find out about this at tax time when they can no longer do anything about it. You found out now. Use it. I will see you in the next one.